welcome to those of you who've joined us, and very excited to be hosting this fantastic report, Overlooked AROs and Financial Stability. Carbon Tracker is a independent, non-for-profit financial think tank that looks at the role of capital markets in the energy transition towards net zero in 2050. And we are looking towards a fully decarbonised global economy by 2050. Our research is very broad, as you can see. We've done many amazing different initiatives, and we look to accelerate the energy transition by positively influencing the financial markets across numerous different areas. And as I say, I do encourage you to check out and subscribe to the website and our newsletter, which you can find hopefully at the end of this webinar as well. You can see all of our work in various formats on third-party platforms, including Bloomberg, S&P Global, and also our YouTube channel, which has undergone a bit of a revamp in recent months. And I highly encourage you to subscribe there and check out. It's like an archive of all of our previous reports and maybe of big value to you as well. But going over to our agenda for today, our guests are Greg Rogers. He's a senior advisor and fellow to Cambridge Judge Business School. He is testified as an expert in environmental and climate-related litigation. He's also been an advisor to BP and its auditors, Ernst & Young, on liability estimates and disclosures arising from the Deepwater Horizon disaster. Second up is Charlotte Gardes-Landolfini. She's a financial sector expert and related to the IMF's Monetary and Climate Markets Department. Prior to that, she was the deputy head of unit in the French Treasury in charge of sustainable finance and climate risk. And last but certainly not least is Robert Schuwerk. He is the ED, Executive Director of Carbon Tracker, our North American branch, and he leads work with security market regulators and accounting standard setters across the globe. Prior to Carbon Tracker, he was Assistant Attorney General with the New York State Office of the Attorney General. And coming to our agenda for this session, we will be covering climate financial stability risk, ARO financial stability risk, AR acceleration, what makes AROs different, the magnitude of liability, do assets cover the debt, creditors' response, and then we'll give you an opportunity to jump in with a Q&A to ask anything that you feel you'd like to clarify or hasn't yet been addressed. But with that, I will pass over to Charlotte. Thank you very much.
Thank you so much, and thank you so much for inviting me. I'm really glad that we can have this webinar today. I'm really glad also that I had the opportunity to extensively discuss with Greg and with the Carbon Tracker team for this excellent report on asset retirement obligations and financial stability. So I'll be just presenting you very briefly what is the current work of the Network for Greening the Financial System on scenarios, and the relationship perhaps with the report itself that Greg will be presenting in a few minutes' time. So basically, the Network for Greening Financial System has developed scenarios, short-term, recently, and long-term scenarios that allow financial supervisors, but also financial institutions to measure, identify, assess, and measure financial stability risks related to climate change. There are broadly 4 types of scenarios that you can see on this slide. These are being actually, I wouldn't say revamped, but like amended currently by the NGFS and by the work stream to which the IMF participates. But let's say that the whole philosophy of them or structure of them remains. So basically, there are orderly scenarios. Those assume climate policies are introduced early and become gradually more stringent, and both physical and transition risks are relatively subdued in the orderly scenarios. But on the other hand of the spectrum, you've got the disorderly scenarios, and those explore higher transition risks due to policies that are being either delayed or divergent across countries and sectors, and carbon prices are typically higher for a given temperature outcome in the disorderly scenarios. You've also got hot house world scenarios, and those assume that some climate policies are implemented in some jurisdictions, but global efforts are globally insufficient to actually halt significant global warming. And so critical temperature thresholds in this type of scenarios, they're exceeded, which lead to severe physical risks and irreversible climate-related impacts, such as sea level rise. And then you have a last category of scenarios that are too little, too late scenarios. And those actually reflect delays and international divergences in climate policy ambition. And those imply elevated transition risks on one hand, in some countries especially, and high physical risks in all countries on the other hand, and primarily due to the overall ineffectiveness of the transition. So as I was saying, those scenarios are currently being amended as the science evolves, as also there has been much more policy discussion around the pace of the transition, around the effects of the poly crisis, also on the design of the scenarios. And on the latter, I perhaps would like to mention that the IMF published in November last year, ahead of the last COP, a staff climate note on the impacts of the poly crisis and especially geoeconomic fragmentation and energy transition policies on the design of the scenarios. So looking at the tail distributions and looking into how the delay in climate policies and energy transition policies, how the geoeconomic fragmentation, how the, let's say, increasingly important impacts of climate change command us to review also the scenarios to be able to assess and account, I should say, for those tail distributions of variables when it comes to the pace of the energy transition and when it comes to the effects of climate change. So this is something also that we have discussed extensively with Carbon Tracker, and that has also implications when it comes to asset retirement obligations and how financial institutions ultimately see those policies unfolding. If we go to the next slide, something really important to have in mind is that, if you're not aware already, is that there is a lot of work being done right now in the financial supervisory community on how can we effectively identify and manage physical transition and litigation related risks and their impacts on financial stability. And this is all happening as financial supervisors, either at the country level, but also at the global level, like the IMF, are conducting climate risk analysis and stress testing exercise for the financial sector. And so the chart that you see here is a pretty common one on how do we go from transition related risks to financial stability risks. Perhaps something worth noting is that transmission channels in the financial sector that include the immediate and the direct impacts that climate-related shocks have on financial institutions, but also on markets and on the real economy, because they trigger existing climate vulnerabilities. So climate-related shocks that could materialize they could materialize in the form of transition risks. For instance, abrupt and unanticipated changes in policy. There could be technological innovation, but also evolution of market and consumer preferences. Those shocks, they can also materialize in the form of physical risks and litigation risks. But they would all reveal new information regarding the value of assets, which could have, in turn, diverse impacts across non-financial entities and affect financial sector balance sheets via their exposures to or income from those non-financial entities and those that are affected, so affected assets and counterparties to the financial sector. So one representation of these transmission channels, which you can see here, shows actually the diversity of potential causes and effects through which financial risks could arise from climate shocks, and that's provided by this chart. So something really important to have in mind, I think, is that the NGFS, as I was saying, is amending both its long-term scenarios, but also short-term scenarios. And so when it comes to the short-term scenarios, and I think that's really relevant for the report that will be presented to you in a minute, something really important to note is that it would describe a narrative where policymakers have to prioritize energy security over climate goals, or the opposite, depending on the countries, depending on the priorities themselves, which could trigger as well some specific climate shocks and climate, let's say, shock waves in the global economy and the financial system, which could result actually in a climate Minsky moment with asset stranding, devaluation of fossil fuel firms, and financial tightening. So all of these issues are really important right now in the global discussion on both how do we design those scenarios, and how do we take those takeaways from the scenarios and apply them to our assessment of the resilience of the financial sector. So I'll leave to that and give the floor to Greg for the presentation of the report. Hopefully that gave you already a good overview of what climate scenarios are and what are the current discussions in the financial supervisory community when it comes to climate-related risks. Thank you.
Yeah, Charlotte, thank you so much for that great introduction to the topic. In short, what the report is about is trying to take that model that Charlotte introduced and apply it to oil and gas asset retirement obligations in particular, just to with the hypothesis that these liabilities could either exacerbate the results of a disorderly transition or might actually serve as a trigger for a sudden repricing event. So, quickly, want to start off with just telling you what asset retirement obligations are, and we've got a list here. I'll let you just look at that. I want to make a sort of a comment that may not be obvious to many people on the call, which is that most businesses don't have asset retirement obligations. Most businesses can simply fade away when they're no longer economically viable. That's a business or an industry. But with oil and gas, that's not the case. There are actual liabilities that arise at the end of the useful life of an asset. In many cases, these assets are very long-lived, but at some point, they no longer have economic viability, and they have to be retired in accordance with law. And in general, those laws are designed to protect human health and the environment. So it creates an unusual end-of-life risk, sort of like a back-end capital expenditure. And one of the questions is, well, when is that going to happen, and is there enough money to deal with it? One of the points that we, in the introduction was that we're forecasting or trying to model towards a carbon neutral economy by 2050. Well, that implies that the fossil fuel assets are going to be no longer useful, at least by that point, and it will have these various types of liabilities to deal with. So next slide, please. So this slide takes the second slide that Charlotte presented, which is the model of systemic risk, and applies it just looking through the lens of AROs. So we start with policy, things like methane regulation, climate-driven. Turns out that low-producing oil and gas assets and idle assets still produce a disproportional amount of methane. Credit de-risking involves ARO creditors, largely the government, but there's others trying to reduce the risk that they end up holding the bag on these asset retirement obligations and having to pass them on to the public or just bear them themselves. Transfer restrictions involves transferring assets where the asset retirement obligation goes along with the asset, often from higher credits to lesser credits. And then judicial rulings. So we've got litigation in this space now for the first time that could present a wild card in terms of the ability to enforce these AROs on the oil and gas industry. So where does that go? It goes into the economy with stranded petroleum reserves and infrastructure. And then those channels can lead to asset impairments, lower profitability, weakened liability or liquidity, and capital resources, and contingent liability from litigation. And then ultimately sort of the same output that Charlotte's chart with financial market losses and credit market losses. Next slide, please. So we're introducing a key concept that's arisen from the fact that we've observed positive feedback loops. I'll talk about some of those in just a second. And we gave that a name called ARO acceleration. And in general, what we're talking about is anything that pulls these retirement costs forward in time, which could be the stranding of the asset, triggering the asset retirement obligation, or that makes it more expensive to defer retirement. For obvious reasons, I think when you see that it's an end-of-life CapEx that produces no return, there's a lot of motivation to prolong or defer settlement of these obligations. But there's some costs that come with that. And then also anything that restricts your ability to offload these assets and the liabilities with them to somebody else, so you just get it off your balance sheet. There's a number of sources of this we talked about. some of them, but lower commodity prices, fugitive methane emissions and fees related to that, higher idle well fees. So many jurisdictions have imposed essentially a tax on idle oil and gas wells. We got shorter durations for those, so you have to get out and actually permanently plug them. Increased financial assurance, we'll talk about quite a bit more. Increased bond collateral, where you have to put up, actual assets to secure your obligation to settle these AROs. Transfer restrictions, litigation damages, and then potentially ARO liability for previously owned assets, similar to regimes that we have in other areas of environmental law. Next slide. So this is the first example of the positive feedback loops that's leading to ARO acceleration. And what, when Rob and I first started working on this, we talked about, obviously Carbon Tracker had been focused for a decade on the concept of asset stranding. But what these AROs introduce is the flip side of that, which we call stranded liabilities. So if there's no viable asset to pay for the retirement obligation, then money would have had to been set aside previously to cover those obligations. And effectively, when assets become stranded, the ARO accelerates in time, but also the acceleration of the ARO can force the asset stranding, and somewhat like a snowball rolling down the hill. Next slide. So here's where it starts to get complicated, is understanding the players in all of this and what their incentives are to act on reducing their risk. We've got three groups here with the ARO debtors, namely the current operators, the oil and gas companies, and in some cases former operators that previously owned and operated these assets. And then we got the ARO creditors. Well, in the first instance, those are governments, because these liabilities and these obligations, they arise under statute and regulation. But it's also landowners. So specifically with oil and gas in particular, where you've got the surface owners are burdened by the oil and gas infrastructure. And in some cases, they may be making money off of that. In other cases, they've just got junk sitting on their property that becomes a nuisance and a form of trespass to them. So they've got ARO claims, both governments and landowners. And we've got some case precedent on that now that say that landowners are, in fact, creditors of these ARO obligations. So we need assets to pay for those obligations when they come due. But in many cases, those assets are being transferred, and in some cases improperly, to buyer sellers of oil and gas infrastructure and to shareholders in the form of dividends and stock buybacks that may be benefiting shareholders at a time when the company is actually technically insolvent when fully accounting for these liabilities, which makes those transfers unlawful. So by introducing the concept of ARO creditors, you start to see that there's credit risk in the system. And these creditors have motivations to try to reduce their credit risk, or the default risk, the risk that these oil and gas companies ultimately don't settle their obligations with their own cash and instead transfer these to governments who may or may not have the money to do anything about them. So we've got this reinforcing feedback loop of asset stranding and ARO acceleration. This is leading to increased ARO credit risk. And what's that leading to? Well, regulations, and particularly financial assurance regulations, where the government's trying to get more security for its obligations, so that will ultimately, they'll have security to settle those obligations if the operator defaults. But it's also leading to litigation. So next slide. And litigation by ARO creditor landowners. So I think, Rob, you're going to take over at this point.
Yes. Yeah. So just following on, the systemic dynamics that Greg has outlined, I think it's important to understand the historical context that we're in as well. And I just want to reiterate, that these asset retirement obligations are effectively CapEx with no return on investment, right? This is just fulfilling an obligation, often an obligation that was, a legal obligation undertaken at the time that permits were required to construct the assets. So where we are today is that we have a long history of deferred retirement and therefore accumulating asset retirement obligations. There has not been a lot of incentive to spend this money, like I said, with zero prospect of return. And regulators historically have not enforced these obligations in a timely manner. And so that has left millions of onshore wells and miles of pipelines that are still out there, particularly in the United States. And I'll talk a little bit about what those costs. But what we've also seen in our research is that the costs are quite substantial. So you could have, $100,000 a well. We have several million wells in the United States, and those begin to add up. And those costs are actually a lot larger than what we saw in the literature in 2018 and 2019. And have been validated both by actual plugging activity in the U.S. and states like North Dakota that confiscated wells, and recent regulations that have been based on estimated costs by regulators. A driver for dealing with this is going to be human health and environmental risks. So you have the risk of contamination. You have the risk as communities develop outside of cities into areas that had been previously drilled. You have the risk that migrating methane and other things could pose a risk to human health. You have nuisance to surface owners and occupants. You have issues with, for example, salt brines spoiling land that could otherwise be used for agriculture or other purposes. Okay. And then, as Greg mentioned, you have bonding requirements, and those are typically requirements that set a certain amount of financial assurance that's needed to operate one or more wells. The operator then has to pay both a percentage of that, which could be quite low, 1-2%, but we've seen those numbers, some evidence indicating those numbers have been creeping up, but also provide collateral in the form of restricted cash or something like that to ensure that the surety bond provider is not going to be left on the hook with those liabilities. I'll get to these last 2 points so we can go to the next slide. So look at this. This is our back of the envelope calculation just for the asset retirement obligations in the United States. And you can see here, looking at these numbers, we would anticipate more than $1 trillion in liability that's in the United States today. Now, not all of this is actually even on company balance sheets. So many times companies will determine that a refinery, for example, has an indeterminate life. And I won't go through the accounting now, but what it effectively means is they need not report what the retirement obligation for that asset is on the balance sheet. So we have both on and off balance sheet liabilities. And many times these are figures that have perhaps been set when the asset was created, but have not taken into account changes and developments since then, including, for example, just inflation in oil field costs that could be quite significant. Let's go to the next slide. So in contrast to that significant dollar figure on the costs, the reality is that there's very little bonding. We estimate for upstream oil and gas wells in the U.S., less than 2% of the estimated costs are covered by financial assurance. This is largely due to having priced the cost of retirement too low and allowing companies to have blanket bonds that may cover for the same amount of money 100 wells or 1,000 wells. So it's not scaled to the magnitude of the risk. This means that the assets, that these obligations are largely self-bonded, and the revenues to pay for them will come from current and future cash flows. What we have seen, though, is that there are many jurisdictions. California is one of them. All but one basin in Colorado is another example of this, where estimated future cash flows pale in comparison to the existing asset retirement obligations in those areas. What we've also seen through the research, you can see this on our reports on the website, is that there is a pattern of large operators, those who do have a continuing portfolio of drilled wells, for example, to transfer late in life or mature assets to those companies that are lesser credit value. This results essentially in an accumulation of credit risk in the system for those creditors, which you might think of banks as creditors. We're talking here primarily about those governments and landowners that are the residual claimants on this liability. Paired with that, there's no sinking funds or restricted asset reserves, as you might find in the context of nuclear, to be able to call upon to pay for this. And companies don't voluntarily set aside cash for this because there is no incentive to do so. And interestingly enough, you can think of the bonding and the financial assurance requirements as a pool of cash to be able to call on, but it also produces an incentive, because if companies had to fully bond these assets, they would be confronted with the actual cost of having to make a decision: do I continue to operate the asset, or do I plug in and get that bond back, which I can deploy for some other purpose? This has resulted in the growing orphan well crisis in the United States. And given the magnitude, in the slide a second ago, just looking at upstream oil and gas wells of $280 billion price tag, the $4.7 billion that the U.S. federal government has provided states for this purpose is really just a drop in the bucket. Let's go to the next slide. So the creditors, and in this case governments, and they have a unique role because they also can set policy, are moving to protect themselves now. So we're seeing that with federal carrots and sticks programs. So that is both providing money, but also issuing performance grants to incentivize states to help themselves by shoring up their financial assurance. We're seeing moves, some of them, half steps today, but we're certainly seeing more political interest in this, in increasing financial assurance and bond collateral. And I should say that that's happening, in places like California to some degree, Colorado to some degree, but also North Dakota and Alaska. So this is, something we're seeing across the globe, also in Australia, I should say. Some of these involve constraining the amount of time that wells can remain idle or imposing higher fees. Others involve imposing requirements of increased bonding at the point of transfer, which disincentivizes putting these wells in the hands of companies that can't afford to pay them. And we're also seeing discussions around joint and several and trailing liability, some of which already exist in other jurisdictions. So that's an important factor. And last but not least, there are now several litigations looking to seek compensation from entities that were predecessors in the chain of title on these assets under theories of fraudulent conveyance and other tort claims. Let's go to the next slide. So, the question for today, we see all this, is whether this is a liquidity crisis in waiting. And part of it is that these liabilities really are not well understood by the markets. And the information that's available through capital market disclosure doesn't really provide a very clear indicator. So first is that if you were to go look at an annual report, a 10K, you would see a discounted present value of those liabilities. But you don't have an undiscounted amount. You don't know the timing that was built into that calculation or the discount rate. And without knowing those things, you don't have an understanding of what the actual liability is, and therefore, if it accelerates, what could happen. Similarly, because the discounting is based on a credit-adjusted discount rate, as companies become greater and greater credit risks, their discount rate goes up, and that asset retirement obligation that's set in the future is discounted at a higher rate, it goes down. So paradoxically, as companies become more risky, these numbers get smaller. You have the off-balance sheet liabilities. Those include, midstream. Those are pipelines. Those are refineries. Typically, those are not even on the balance sheet at all. One of the slides I showed you before was $760 billion is an estimate for retiring the pipeline infrastructure in the United States. And that's mostly just pigging it, making it inert, and leaving it in place. That's not pulling it out. In some cases, that would also be required. So substantial liabilities are there that are not on the balance sheet at all. The assumptions about cost and timing are entity specific. That means it's not something that analysts can really use as a comparison point between companies, which means they don't use it, and so you don't have that information. Opaque disclosures, to give you an example of that. If you were to look and see how many wells does company X own in the United States, you would not see that. You would see likely how many producing wells the company owns. But in this case, what you really want to know is how many non-producing or low-producing wells does the company own to be able to understand the exposure of that company. That you will not find in the annual report. And then the last is all of the positive feedback loops that Greg had mentioned earlier mean that you can have a self-reinforcing chain of events. And you could see some of this even in some of the things that have taken place so far. So, for example, in the first quarter of this year, Chevron took a $5 billion impairment due really to two principal items. First was effectively contingent liability in the Gulf of Mexico. They had previously sold assets to an entity that went bankrupt. Because of the joint and several liability regime in the Gulf of Mexico, those had to come back to the company. There wasn't a provision, for that liability, so they had to, take a loss at that point. The second portion of that was related to change plans in California. From the company's perspective, those were based on changing regulations, including a bill, AB 1167, that increased requirements for bonding at the point of transfer. And so it had to take a substantial impairment there as well. So we see signs that these things are already occurring, and there's a question whether they could occur at scale. And the last point I want to make is that a lot of the things that we've mentioned in terms of regulatory reforms are not novel. They exist both in other areas of environmental law, and in many jurisdictions, they are obligations or requirements already imposed on the oil and gas sector. So the possibility that as governments, as creditors seek to de-risk from this liability, they will look to other jurisdictions that have these and follow similar policies and patterns. And that's why we think that this is something that requires, further study. Let's go to the next slide. So just final thoughts here. AROs amplify the potential harm from and could be the spark potentially that ignites a climate-related financial shock in oil and gas asset prices. And the probability, timing, and hedging strategies to deal with this warrant more study. And I'll leave it there.
Thank you, Rob, Greg, and Charlotte for that very informative presentation. We'll be now moving to the Q&A portion. If you have any questions, feel free to drop it in the Q&A chat. So let me go ahead and get... All right, so we have a question from James. And he says, it's clear they believe that they will never have to pay for these risks, even if they're specifically talking about oil and gas investors, even if they become real. Is that a collective delusion, or do they know something the rest of us don't?
Greg, you want to take it?
Yeah, so I'll take that one. I think forecasts of the future, I think, are largely based on past events. And I think looking backwards, you would say that there's ample reason to think that governments won't enforce these liabilities. Industry will never have to actually pay them. I think what's different and what makes the future uncertain are really two things: climate change and the energy transition. So it's one thing to look backwards when fossil fuel energy and domestic energy independence was a huge policy priority in the United States. And there were many reasons to try to reduce that cost and reduce cash outflows for things that could be deferred in the industry as a way of supporting the domestic oil and gas industry. That future looks like it's going to change significantly if we have, if we're at all serious towards, decarbonizing by 2050. Then it's clear these liabilities are going to be coming due, sooner than might have otherwise been the case. And once you start recognizing that, now you've got credit risk, whether you're a government regulator or you're a landowner. And the second thing you have is you're looking at a powerful industry that is going to necessarily need to fade away. Not necessarily that the oil and gas companies will not be in the energy business, but for policy reasons, they may not be in the oil and gas business that much longer. So that changes the reality by putting a time frame on the wind down of the industry. And I think that, the basic answer is I don't think past is prologue here. So, and this is really the point we're making, is that investors need to look at the situation through a different lens, not through the lens of the past, but through the lens of the energy transition.
Thank you, Greg. Our next question is from Sarah. As we see increased onshoring of energy in the United States and broadly across countries, how do you anticipate this impacts the ARO liabilities we see?
Rob, do you think you've got a handle on that?
Sure. In terms of onshoring, I think, I can't say that I had appreciated that as a pattern in the sense of, I think what you're saying is literally more onshore activity. But I would say, looking at the U.S. context, if that's the case, onshore versus offshore, there are a couple of differences. So, onshore activity in terms of, is often on fee land. So it's on private land. So you've got additional claimants. And in fact, some of the litigation we're seeing is coming from folks like that. If you're offshore, you're dealing principally with governments. On the other hand, in the U.S. context, when you're talking about offshore, you're talking about the joint and several liability regime, and that exists in other jurisdictions as well. And that's an important one, I think, to keep in mind. We did a study looking at all assets in the Gulf a couple of years ago. I believe it was called Double or Nothing. And what we showed was that the oil majors were responsible for, or in the chain of title, and therefore potentially liable for some or all of these liabilities, up to about 75% of all assets in the Gulf, which is, significantly more than what they own today. And so I think if you start to see this unravel in places that have that regime, you're going to see an accumulation upwards of these liabilities concentrated in companies that arguably could afford to deal with what they have on their balance sheet today, but those liabilities are not on their balance sheet today.
Thank you, Rob. Next question is from John. How are AROs factored into reserve valuations? Are there any examples of recent oil and gas acquisitions that explicitly take AROs into account?
I'll take a crack at that one. First of all, in general, AROs are not considered in reserve valuations. The SEC believes they probably should be. But to the extent they are, they're in an aggregate form where you can't break them out and see exactly what the numbers are. I think in general, what we've learned is that the industry and the petroleum reserve engineers on this have largely assumed that these end-of-life liabilities will be passed on at some point. They'll just go on to smaller operators. In a sense, there's an implicit assumption that they'll be socialized, and that they're not actually an economic cost to the entity that should be tied to the economic value of the reserves. What I think a follow-on question to that is how are these assets valued? And in one sense, you could value them at the cost to actually perform the work, to perform the asset retirement activities, as if you're going to have to do that today, and then you could discount that. Another way to look at it is, well, what value does the market place on them? And that kind of goes back to what I was commenting about the reserve reports. If you assume that these liabilities would be passed on to smaller and smaller entities, lower and lower credit worthy entities, and that ultimately they'll be socialized, then the market value of these liabilities is not very high, right? It's heavily discounted by the assumption that there will ultimately be no enforcement and that they will not be paid. So this is something that the industry itself has got to come to terms with, and the accounting world, I think, has to come to terms with, as well as the reservoir engineers. Do these end of life liabilities need to be explicitly measured and accounted for, not just in the context of financial accounting, the financial reports, but in terms of the asset valuations and what actually are proved reserves? The problem is in the definitions of producible quantities in the regulations of oil and gas, is they do not take into account these end of life costs, which essentially need to be amortized and allocated over the producing life of an oil well, for sure. And in many cases, they're just left off. So in other words, from a regulatory perspective, looking backwards, an asset can be operated profitably as long as you can get a barrel of oil out of the ground and make a penny on it, without considering at all those end of life costs, which are just left there at some point, almost by definition, with no future cash flows to pay for them.
Thank you, Greg. Next question is from John. Are we already in the crisis phase? As I noticed, several U.S. refineries have been unable to find buyers.
Well, I think we're seeing signs that this crisis is there, both in terms of the things we mentioned in terms of regulators and creditors beginning to act on this. Certainly, there is, if you look at literature from the oil and gas industry on global refining capacity, there's some argument that there's a need for rationalization already, which would be a reason why people wouldn't want to buy some of these, right? And the picture on AROs is only going to make that more consequential. So as Greg pointed out, to the extent there's a implicit assumption that these liabilities will eventually be socialized, people aren't valuing them highly. And to the extent that changes, you're going to see that, which would certainly make it more difficult to offload. I can't say that I've seen any study that definitively pointed that to the reason for any inability to sell refineries, but I do know what you're saying in terms of, Shell endeavored to sell a couple of refineries, I think in Louisiana, was unable to and had to decommission them. And in fact, interestingly enough, it was basically at that point that they finally brought those liabilities onto their balance sheet. They weren't there before.
Thank you, Rob. Next question's from Rhonda. What do you suggest that investors ask oil and gas companies' audit committees about their oversight of these issues?
Well, that's could be a lengthy response to that question, but I would say a couple of things to think about. I think the audit committee certainly needs to be aware of the accounting requirements, which are quite complex for accounting for these. They're expected present value estimates, ultimately a fair value estimate that includes even market risk in that number. So they're complicated. The accounting is complicated. It's also complicated to understand that you've got these assets that are assumed, if they're assumed, that they can last forever with proper maintenance, that you simply don't value those at all. So there's no disclosure. But from the board's perspective, they need to understand what the undiscounted cost is. So not discounted over the next 20 years, at a credit adjusted rate. What's the cost today? If we had to do this today, what is it? And there's an implication that goes beyond just the accounting and getting the accounting right, and that's solvency. At some point, these liabilities, if they accelerate and they come onto the balance sheet in a real way, so a lot of companies are going to have negative equity. The board needs to know that for sure, because if they're already in that state, and we believe a number of companies already are, any dividends, any stock buybacks, those are illegal. The board has direct fiduciary responsibility for that. So I would say the first thing to an audit committee is, if you're relying solely on the financial statements, how these AROs are presented in the financial statements, you may be missing a lot. And you need to dig deeper, and you need to understand the full scope of that liability aside from what actually has to be reported in the financial statements.
Thank you, Greg. Next question's from Peter. Can you talk more about unlawful dividends and legal wildcards?
Why don't you take that one, Greg? You were just getting.
I'll take it. What was it? Can you repeat that, the last part of that question, Nina?
I'll repeat the whole question. Can you talk more about unlawful dividends and legal wildcards?
Legal wildcards. Okay, well, sure. So I see how those are related now once I understood the term. So the basic concept here from a legal standpoint or a litigation standpoint is of a fraudulent conveyance or a fraudulent transfer. Taking assets that are needed to settle a liability to a creditor and giving them to someone else. Often it's to an insider. So where the smaller, closely held companies, right, the shareholders are effectively the same as the directors and the operators of the business. The concern about unlawful dividends is a variant of fraudulent transfers, which could arise in a sale transaction or just a transfer of assets in any way whatsoever. But a closely related concept is unlawful dividends. And this arises under state corporation laws, including the biggest, Delaware, that make it unlawful to transfer, to pay dividends or engage in stock buybacks at a time when the fair value of your liabilities exceeds the fair value of your assets. All right. This comes back to the discussion that we're talking about. These off-balance sheet AROs and the concept of ARO acceleration can catch you by surprise. And if you're not monitoring what the undiscounted costs of all these liabilities are, whether they're on your balance sheet or not, you may be in a situation where the fair value of your liabilities exceeds the fair value of your assets, and you simply don't know it. So that's the concern. Now, is anybody going to bring a case about this? Well, yeah, maybe. We're starting to see that there are claimants that have understood. There's 2 pending pieces of litigation in the United States based on this theory of fraudulent transfer under state law. There's also a federal equivalent to that. So landowners whose land has been burdened by these derelict assets that the oil companies have walked away from are starting to learn that they have a remedy in court, a way to enforce these liabilities against an operator, and not just the operator that's currently owns these wells, but perhaps prior operators who, again, were engaged in transactions that were with a party that was either insolvent prior to the transaction or made insolvent as a result of the transaction. We got a lot of derelict wells across the United States sitting on a lot of fee property, as Rob mentioned. So it's pretty reasonable to expect that as landowners come to know that they have a remedy, that they will seek counsel to help them exercise that remedy.
Thank you, Greg. Next question's from Paul. Does the Vermont new oil and gas Superfund bill address any of this?
I haven't read the bill, but from the news reporting, I don't think it would. I mean, that bill is primarily addressing the physical impact of climate change. So, and the fund is going to be used for infrastructure, resiliency, and things along those lines. But if there's some provision in the bill, it just hasn't been in the press. I'm not sure.
I want to just tag on with Rob. One concept, I think this has not happened, but it is in the discussion stage in rulemaking in at least one state that we know of, which is the audience may or may not know, but upstream oil and gas is exempted from Superfund or the CERCLA in the United States. There's literally a petroleum exclusion. And some states are considering whether that makes sense anymore. It did at the time, but the concept of applying joint and several liability to the oil patch would be significant if that were to happen. And it's a point is it's being discussed at this point. Now, it relates back to an issue that we didn't quite put our finger on, I guess, earlier in my comments of regulatory capture. But I mean, politics play a role here, certainly, in establishing new policy. The oil and gas industry has been dominant and highly influential in this country, so policies tend to favor it. I think one could reasonably expect that favoritism will start to wane and may actually reverse as the oil and gas industry becomes less and less important to the U.S. and global economy.
Thank you, Greg. We have a question from Mike. Do you think we'll see more policies aimed at operators funding decommissioning expenses over the life of the project, as is required in Angola and Nigeria?
Yeah, I mean, I think that's certainly possible, and almost every regulator has a two-pronged problem to deal with this. So first is you could think about as getting the proper incentives in place for operators, particularly those that have the wherewithal and the ability to pay today, and that's essentially confront them with the full cost of retirement up front through the form of some kind of financial assurance. You could also consider sinking funds, which would be something more along the lines of what you're talking about, where they're putting money away year over year that will accumulate to the point that it will be sufficient to cover the cost of decommissioning going forward. So there are some pretty straightforward policies that are available where the asset value is not exceeded by the liability. The second prong of the problem that people have to deal with is that we have already passed that stage for many oil and gas assets in the United States. And to the extent those assets are now in the hands of companies that lack the ability to pay, and we see this in many jurisdictions, that's going to require other solutions. We are seeing some of those. So there was legislation in Australia, for example, that socialized the cost of retiring a derelict offshore asset across existing industry. We see in Colorado, for example, certain levies that go to an orphan well fund to deal with the liabilities of those that have gone bankrupt and not fulfilled their obligations. So we're seeing those that currently I wouldn't say that in Colorado or anywhere else they're anywhere near sufficient. But the idea behind it is if these are deadweight losses that have to be suffered by someone, they should be suffered by the industry that has profited from the practice first before being put on taxpayers.
Thank you, Rob. Next question's from Larry. Have there been any studies or assessment of how ARO liabilities are distributed across companies in the space in the U.S.? And what companies, if any, include AROs on balance sheet at fairly accurate cost?
Well, go ahead, Greg.
I mean, that's a difficult question because it's one of the problems is, as Rob was stating earlier, the disclosure is so inadequate to reverse engineer the numbers that actually are on the balance sheet to understand whether the assumptions are reasonable or unreasonable. So that you end up painting with a very broad brush to try to answer a question like that. And you have to make a lot of assumptions to get to the question of whether the numbers are accurate. I'll say that we've got uniformity in the sense that you do have to put a number on the balance sheet for your upstream oil and gas wells. Why is that? Because oil and gas wells do have depletion rates. An oil well will never produce oil forever. There's only so much in the reservoir. It costs so much to get it out. At some point, it's not profitable anymore to produce from that asset. Therefore, you can reasonably model the ultimate end of the life of that asset and should therefore be able to come up with a reasonable estimate of the ARO. But we've seen some companies, publicly traded companies, that make assumptions like that they're going to operate these assets for 70 more years. Obviously, that's in a bit of a conflict with perhaps economic reality, but it's also in conflict with the energy transition. So you could pick certain companies, I suppose, and say these appear to be unreasonable estimates for their AROs. The other side of this is we have uniformity in that if you can't reasonably anticipate the retirement date because the asset can be operated in theory forever, as long as it's maintained, those liabilities are not on the balance sheet at all. And the ratio of those, upstream oil wells versus pipelines versus other things will vary by company.
Thank you, Greg. This will likely be the last question. What other industries have required AROs or end-of-life liabilities that should be better understood in the investment industry broadly?
Well, I'll take one on that is coal is an example. And we've got clearly the nuclear power industry has this, but also the coal-fired power industry has these end-of-life obligations largely related to the management and disposal of coal ash. And we had new federal regulations that came into effect in 2015 that is imposing significant closure, post-closure, and corrective action obligations on utility companies for these waste management units, which were largely unlined surface impoundments. So those costs are now being litigated in the United States with coal-fired power plants. Companies that previously were in the coal business are suing their insurers to try to get recovery of these costs, which are running into the hundreds of millions of dollars. Unclear how that insurance litigation is going to play out. Unsure how much of these costs can be reasonably passed on to ratepayers and regulated, for regulated entities, and how much will actually be, eaten by the company that could affect their returns. So that's an area I would keep an eye on.
Thank you, Greg. We're at the end of the webinar today. If you had a question that was not answered, we will be answering them via email. So do not worry, we will get to your question. But thank you for joining us today, and we hope to see you at other webinars. I'll pass it on to Piotr to close us out.
Yeah, thank you very much, Nina. Thank you very much, everyone, for joining. As I mentioned at the beginning of the webinar, if you would like to stay further in the loop with what Carbon Tracker is up to, then be sure to subscribe to our newsletter. It's gone through a little bit of a revamp, which I personally am quite excited about, and also our YouTube channel, which I'm also very excited about. We've also released our new data portal, where a lot of our previous work in information and statistics and generally things along those lines is available. So I highly encourage you to check it out, and look forward to seeing you all in future sessions. But that's it from us. Thank you very much.